quite a few where clients on modest income, they've listened to the advice, they've got 3 or 4 investment properties, their net worth's probably 5 mil now, and they cannot not get to 11 or 12 or 13 million over time if they just keep doing what they've been doing. Most people put the queue in the rack when they own the house. That's the time to double down and to leverage up.
Your strongest earning years are going to be between that kind of 35 to 50 years old. Once you get to 50, you're either going to scale back from work or you're probably not going to get the promotions. So you've really got to capitalize on that while you're there. You built up a great property portfolio, loan book of over $4.5 billion. What are the mistakes people are making before coming to you?
The biggest one? I see the next 5 years being really, really strong and a great opportunity for all those people that think they've missed the market because assets have gone up or grown to get in there now still and enable wealth and take advantage of the problems that we have in Australia. So negative gearing is really the loss off the property comes off your gross income. So very simple. I tell my clients all the time, just remember loss off gross, and you understand negative gearing for the rest of your life. The one thing I've learned from investment, and I've been doing it since I was 21,
Alrighty, Mark. So it's good to have you back again. Obviously, first episode, we weren't able to really get into the nitty gritty, but I think a lot of our listeners or the feedback's been that they got to know you and the business and walked away with some tidbits. But thought we'd get you back in today. We really want to kind of maybe dig into some weeds and, some things that are going on your side of the business and, just in the lending market in general. Mm-hmm. So I've got a few things we want to cover off today. Probably the first one I want to ask you, and I'm sitting here, you built up a great property portfolio, loan book of over $4.5 billion. And I know you're still client facing each and every day. Like there's a lot of people in your positions where they're handballing that off to their offsiders. And you love to get out on the golf course. What in the bloody hell is driving you to still do what you're doing?
You can only play so much golf. Golf's that game you go backwards pretty quickly if you start playing more. But no, I'm only joking. But what's my drive? My drive's helping people, to be honest, really, and improving their position. I don't want to do basic home loans. I don't want to do generic product offering. It's all about improving clients and making changes and making a difference to the world. And ALIC has been built. We built it from day one to make a big difference out there. And we've reached quite a few thousand customers out there over the last 15 years, and we've got a lot more to reach. So what drives me, it's just passionate about assisting people, helping people, and enabling wealth and getting people to own their house and getting them into a position that they aren't under pressure. That's, I think, I've probably been put on this earth to help people financially, and it's just my niche, and I love it.
And I don't mean to put this back into myself, but I think for me, myself, I'm a little bit the same in terms of, I grew up public housing, never lived in a house that we own as a family. Yeah. And I have this crazy vision in my head that I want to, fill up Rod Laver Arena one day in terms of the amount of people that have actually helped in their side, actually get their own home, set themselves up for retirement, their kids. What's the big thing for you? Like, is there a kind of little thing in your head that you're like, I want to get, that's the only time I'll feel complete, or is it just, I'll never feel complete, I'll be doing this? I'm
an Aries, so I don't think Aries are ever complete, are they? When they win something, they want to win the next thing. Yeah. Okay, so a lot of people say you're driven by awards and all that type of stuff. Not really. If I lose, I want to know why, and let's change it. So as a typical Aries does, they just move on, and then they change it, and they just keep driving it until it works. So I suppose another side is my background. Really cautious parents. I covered off in the last episode, you either follow your parents and with a similar risk profile, or you actually challenge it. And I'm one of those that challenge it. My parents have never owed money or owed much money. And yet I'll take debt levels up to 10, 11, 12 million with no concerns at all. So people either follow it or rebel it. And I suppose I've rebelled it. And also I just put my toe in the water when I was 21 and it worked. And if something works, why stop it?
Yeah, kind of feeds I won't call it addiction, but just drives you more.
Just changes
right?
you.
Yeah,
you change. Like I'm actually, people won't know this, that my customers would think I'm quite an aggressive investor. I'm actually quite cautious, risk averse. I minimize risk every way I can with income insurance, with cash flow buffers, with the best property data, with the right markets, the right purchase price, the right strategy, the right exit strategy. That's risk minimization strategies, and that's critical. But people wouldn't think, who don't know me, would think I'm quite an aggressive investor. I'm actually quite cautious, but I put the mechanisms in place to make sure it's all protected.
Awesome. And I guess one of the things I know I've asked you, and you kind of had to go deep into the memory bank, because I think everybody, you always have clients that you want to make wins for every client, but there's always maybe one or two stories that stick out. Like, what's the one that kind of is, you're like, geez, I'm so happy with that client. We got them to achieve A, B, and C. What does that
The
look
one that
like
brings me back and says, well, I love this job. So every now and then I'm at work and I go, oh my God, how good is this job? Yeah, so it's that one. But there's not just one. It's like, and I can't mention names, but there's quite a few where clients on modest income, they own the house outright. They're all set up to a T. Their house is worth 2 or 3 million. They own it outright. We've just bought and sold 6 or 7 investments over time. They've sat on budgets. They've listened to the advice from 12 years ago. They've got 3 or 4 investment properties. Their net worth is probably 5 mil now, and they cannot not get to 11 or 12 or 13 million over time if they just keep doing what they've been doing. And I just sit there and go, wow, it's a customer who came to us 12 years ago, probably worth 200 or 300K, and they're sitting there worth 6 mil. With a play now to really advance that significantly over the next 10, 12 years if they just keep following the rule book.
Absolutely. And I guess for yourself, you're a big believer in this, and probably so am I. They've wiped off the home loan. And now,
non-deductible debt's gone. So in that case, this person might be, just so I'll give an example. I know who I'm talking about. That Say they're on 150K each. Okay, not good jobs, but not amazingly, not a 400K income. They've worked the whole time. 2 kids, own a house worth 3 mil, and they only spend 20 to 30K of their total income of 320K gross to run investments. So it leaves them a lot of money left over for cash flow. So they can easily afford it, but they're leveraged up. They might have 4 investments at, say, 2.5 or 3 million worth of debt, but their net worth is X. It costs very little to run, and it's exciting to deal with those customers and take them to that level. And the ones you do that for are very appreciative and are lifelong customers.
Absolutely. And I'm sure the friends, family end up coming through because, like you mentioned, they start off of their journey, their risk profile is one thing, and then it's like an education. You get that taste for it, you keep coming back.
Well, if they talk to their friends go, who's doing this? How have you done this? Because when you're on 160K each, you're not supposed to be worth 6 million.
Yeah.
In most cases. Yeah, but if they do the right things and save, and those customers might save 50 grand a year, okay, but then spend 30 on investments. Okay, so over 4 years, if you get, and you've got 8 million worth of assets, in this case, this person's got say 7 million worth of assets. If you're getting 40% growth over, say, 3 to 5 years on that, 40% of 7 mil is about 3.2. If you're saving over 5 years, 50 grand, that's 250. There's another 3.4 in 5 years of net worth. So the power is, once you own your house, because the cost is so low to run the investments, with, say, rates, and I'll explain why it's low. If you've got a rate at, say, 5.8%, but you've got a yield at 4.9, okay, close to 5% yield. The running cost to run, say, a 600K asset there might be 13K pre-tax, 11 to 13, post-tax 5 to 6 grand, and that's 100% geared. So anyone out there can afford 5 to 6K. Okay, so
absolutely.
So if they've got 4 of those, that's 20 or 30K to run those assets.
Yep.
So we can all do it, but the power is the reduced non-deductible debt. Getting that down, and then, and I will cover this off just quickly, most people put the queue on the rack when they own the house. That's the time to double down and to leverage up.
And it's because you only got, you touch on this, and I try and educate our clients that we work with as well, in terms of your strongest earning years are going to be between that kind of 35 to 50K. And, once you get, 50 years old, once you get to 50, you're either going to scale back from work, or you're probably not going to get the promotions or do those kind of things, or you want to work one day or a week or whatever it might be. So you've really got to capitalize on that while you're there. If you're lucky enough, you've ticked off the home line by 35, 45, it's not just about, like you said, putting the queue in the rack. It's time to actually put it into overdrive, because realistically, your home's paid off.
But 8 out of 10 people put the queue on the rack. Why? So they had this pressure for 6 grand a month or 4 grand a month every month for, say, 15 years, yeah? And then they haven't got that anymore. So what most people do, increase their living expenses, go on more holidays, but they don't allocate a portion of that to go to investment. And if they did that, okay, and with no non-deductible debt, that's when you can really leverage up and take advantage of your net worth and growing it significantly, purely through leverage.
And like you said, it could only just be another 5 years from there where you can get 40, 50. Sometimes if you get a really hot market, you might get 100% in that 5-year period.
Yeah.
So it's just about pushing that finishing line, I guess, just out that little bit more and capitalising on that.
And that's a lot of fun. It's a lot of fun getting people to own the house outright and living in their dream house. Okay, and then it might be go to a holiday house. We might short-term rent it for a period of time so we're not under that non-deductible debt pressure again. And then from there, just allocating everybody out there should just be allocating a percentage of their income, net income, to run investments. And you'd be surprised. Most people don't allocate enough to run investments.
And you kind of touched on that. So that's probably my next question I've got for you.
Yeah.
What are the mistakes people are making before coming to you?
The biggest one?
Yeah, or even a few, yeah.
Emotional decision. I'll give a few, but the biggest one's emotional decisions. Buying in the wrong markets, not using professionals, buying small land, not negotiating it properly.
And it's someone, they want something nice and tidy, I'm assuming. They go buy this tiny little house, or this bit, maybe it's a big size house, but on a 200, 300 square metre block. All the bays in the house instead of the land. Yeah, is that what you're kind of referring to there?
Yeah, well, I'll give you one this morning. I had a meeting this morning. That customer bought a property 8 years ago in Paran, and it's only worth probably 100K more than what you bought it for 8 years ago. Where if that was put into other markets, it could be worth a significant amount more, and it's small land, really small land. And now the question to the buyer's advocate, because we can't advise on this, is it something we should hold? Can we renovate it? Should we renovate it? What else can we buy? Okay, and then how big a home loan debt does she want to have if she renovates it? Okay, and then combining that with other investments that she needs to go and get into to be able to clear that debt. So the biggest errors is the emotional side. So that was an emotional decision. Pretty bad timing. Melbourne market stopped pretty much 7 or 8 years ago. It's probably only done, 10% growth in 8 years?
It didn't really recover since the APRA changes, really. Like, there's been some growth, but when you compare it to, say, Perth, Brisbane, Adelaide, it's really just ticked along with inflation.
And negative growth the last 4 years. So, and we've seen the valuations on her property for the last 7 or 8 years, and there's nothing there. So whether that's going to be a great market moving forward. So we've got to get her to the right people to get the right decision about that asset, particular asset, and where she moves to, and then what other parts of her strategy she wants to do. So the other errors or mistakes that people make is not understand cash flow, don't understand pre and post tax, and don't have those funds set aside. So what I do with a lot of my customers, they might have 3 or 4 investment properties, and we'll set a certain amount of cash that runs all their investment properties. So rent goes in there, expenses come out. So expenses are rates, maintenance, management fees, insurance, water, that all comes out. And there's enough there to run it. So you're not looking for cash to run the assets. Then the tax refund goes in, and then each year they put 10 or 20K back in there, and they sit and forget and run it again. So people don't understand the cash flows. In most cases, they come to me and say, I'm under pressure. This is not working. And by the time we sit down and do the numbers, it's normally just the way that they're thinking about it.
Just touching on that, because I know personally dealing with some of your clients and clients that are, just come through us. What are some of those strategies? Is it buffers? Is it, refinancing? Like, what does that look like for somebody in that situation?
Well, everyone should have a buffer. Okay, everyone should have offset. Everyone should have a buffer. I think I've given out 2 loans without an offset account in my life. Okay, so we should always have buffers and offsets, and we should know our cash flow pre and post tax. And those buffers depend on your risk profile, your comfort level, your family position, your private school fees, whether you need to go overseas to see family, or lots of various different things. And I know some people can live on $4,000 in the offset account and have nothing, and they'll have 5 properties. But then other customers will need 200K sitting there to feel comfortable. So it's about, how do you sleep at night? What do you need? Okay. Yeah. So does that answer the question?
No, absolutely.
Yeah.
It definitely touches exactly what we're looking for there. And I guess we've got you back in again today. We also want to get into maybe some nitty gritty areas, not just all about yourself. Some things you want to be we want to touch on. And I guess this session today is being recorded at the end of July. We got the rate cut, or the lack of rate cut, at the last RBA meeting, I should say. And I guess, what, in your opinion, why did that happen? And I guess, where do you see rates personally moving forward on from here?
Well, clearly they think there's an inflation issue still. Okay, so they haven't dropped rates.
Do you think it's that, or do you feel like they're a bit gun shy based off, they're still probably wiping the egg off their face about the note, which I guess, to put them to their credit, this wasn't really their fault. They can't really call a once in a generation or once in a lifetime type of pandemic, right? But maybe a bit gun shy. Do you think it's a little bit of that as well, or are they waiting? Obviously, they don't sit as often now. They're only sitting 8 times a year. And are they waiting for the next quarter, for the next...
Maybe look at the new stats, but I think they're always gun shy. I mean, you look at GFC, Royal Commission, COVID, they're always quick to increase and slow to decrease. And then in each of those 3 times, they have to rush it through and have to decrease significantly. So I think it's just something we've got used to. It's how they operate. It's an opportunity for investors out there.
Yep.
It's going to prolong the investment market to a degree, okay, because investors are waiting for those rates to come in. So if that slows it down and it comes in the next 2, 3, 4 months, this market will technically be longer. I mean, that's more your domain than my domain.
Yeah.
So we're just in the situation that rates are going to drop.
Do you think we get one in August?
You'd nearly guarantee it, wouldn't you?
Yeah, I think so.
So that comes through. It's going to relieve the pressure. Just I wanted to touch on that in the last 2 rate drops, the investor market's probably increased by 20%. So, and we knew that more investors are going to come out and play, which is going to be more competitive. It's going to make it harder to buy. It's going to increase prices. It's going to increase rent, all types of things. So we're in a situation moving forward that the more that drops and the quicker that drops, the more people will be coming out and the busier we'll be. So it's looking like a very good year from an investment lending perspective. But the market's prime, in my eyes, for growth.
I guess jumping in there in terms of, speaking with, other brokers on your team and just brokers in my personal network.
Yeah.
There's, I guess their feedback is they're writing, anywhere from 20 to 50% more pre-approvals than they were in Q1 of this year.
Yeah.
Are you feeling that on your side of the business? Like, is the ALIC brand or even your personal loan book, are they on track to have a average year, great year, PB year? Like, what does that look like right now?
Yeah, so our clients are mainly investors, as we mentioned. So investors should be looking in this market because there's opportunities. It's the price has been low. You look at Victoria, that's had 8 bad years. So those customers we're getting all our customers prime, ready to go. Okay, rates have come down, borrowing capacity has gone up slightly. We can use 2nd and 3rd tiers to increase borrowing capacity. There's normally a way around it, and customers may have just gone and sold some assets in ROM markets or growth markets out of Adelaide, Brisbane, Perth, to reduce home loan debt to get them back under the line. So when I say the line, you've got a borrowing capacity. Everyone's getting under the line to be able to get ready to go. So I suppose the last 2 years we've been getting our customers ready to get into that position, knowing that if rates come down, investors will come and play, and you want to be in the market and not miss that opportunity.
Yeah, and is that leading to a busy year for you guys? Like, how you feeling the pinch right now, or is it quiet? Like, what is that?
Yeah, it's busy as at the moment. Yep. We're doing our biggest month. So in June we did our biggest month. June's our biggest month at all times for tax reasons.
Yep.
We just did our biggest June in 15 years, and we're about to do our biggest July in 15 years. But we've got more staff on. We've got more investment lending managers in our business now. So they're all been trained up over the last 3 to 5 years. So we should be doing more technically, but also the feel is it's a hot market. It's going to get hotter, and there's a massive opportunity in the property segment, which Ripehouse know more than us over the next 3 to 5 years. So yes, we're excited.
Yeah, I mean, even from our side of the fence, we're definitely having a lot of previous clients who have either been with us in the past or maybe engaged a conversation but didn't follow through for whatever reason.
What's your feel on that on the market at the moment?
We're definitely having a lot of clients come back they want to go again. They purchased in 21, 2022. They're seeing rates cut. They're reading in the news that all the major bank economists are going to see more rate cuts, 3 or 4 over the next maybe 12 months as well. Yeah, that investor appetite is getting stronger and stronger each and every month. And hopefully it is like this, but it gives me kind of vibes of that 2020 kind of a little bit after the pandemic event where people are starting to get a little bit of FOMO, which kind of goes into my next question. Now, what was the percentage of brokerage loans? Something like 70, nearly 80% at the moment, right?
74. Some people will say 76, but call it 75% of lending in Australia is done through broker.
Yeah. And, we've probably seen you're going to know the exact numbers or more than me, but we've obviously seen people shift from, and most people are on fixed loans, right? Crazy 1.99, 2.9, and then everybody's now on variable.
They've all nearly come to an end. I think about 95 or 96% of them.
Yeah, I did see a little graph. I never checked the sources on those graphs but on them LinkedIn, but I did see that. Do you see that as maybe, because I've got an opinion on this, that maybe that's going to drive the next wave of pouring property investors or just people in general, right? Because the banks now no longer have you locked in to let's call it a contract per se, right? So you're sitting there, you're potentially a walking cancellation to the bank. You could go from one lender to the next. Do you feel like once they have the confidence that, all right, rates are where we think they're heading and they're there now. I think I walked past a signboard at just Aussie Home Loans in the shopping centre the other day, and Macquarie's offering a 3-year fixed rate of something like 5.19. Now, you never know what the terms and conditions are of those.
Yep.
But do you feel like once there's a fantastic fixed rate product in the market, that's the next shift where everybody's going to come in, get locked in on low interest rates, proves their borrowing capacity. They have that conversation with a strategic broker like yourself where they go, you're sitting down, well, great, got you at a fixed rate, your cash flow's improved, or we've got, you also got borrowing on the table. Yeah. Do you feel like that's maybe the next thing that's also going to give it that other shot in the arm?
Well, going fixed doesn't actually improve your borrowing capacity because it's a servicing rate the banks have to use. Okay, so whether it's fixed or variable, it's the same. I think the undereducated people will actually look at it and go, wow, this is good. I'll take what I can now. So if you're really struggling on cash flow and you feel like you've got the noose around your neck, it would be very attractive because even if it's going to go further down, some customers will go, you know what, at least I know where I stand. I know I can afford it. I know I'm protected for 3 or 4 years. I'll go fixed. And those people should fix. But the educated people that are okay around cash flow will obviously won't be jumping on those early fixed rate campaigns. But of course the banks are going to come out there and try and lock some things away because refinance is a big market out there.
Yeah,
banks are doing everything they can to retain those customers, and that's one of the methods they use to hold those customers.
And I guess touching on that, so they want to retain the customers. Do you feel that the banks support brokers well? And you can be as honest as you'd like here.
It's a good question. Do banks support broker? To a degree, they support broker. They should support more. If you've got 74% of the market, why wouldn't you support it big time? It's actually cheaper to write a loan through a bank, through a broker, than through a bank. Through a bank, you've got wages, you've got rent, you've got all their different expenses. Okay?
Office costs, you got to put bums on seats.
So I've got theories on this. Okay, I've got theories that the banks actually want that percentage down. They want to drive their proprietary channels. I've got theories that they're going to lose market share by doing this because a lot of broker-oriented banks like Suncorp, who don't have much proprietary channel, Macquarie, will get market shares.
And can I just jump in there for people? What's proprietary channel? Just so
is that like the branch network?
Yep.
Yeah, the branch network. So you got a situation here where Macquarie is all broker. So Macquarie, Suncorp, some of these smaller ones could really take a big market share over the next 2-3 years as the banks, I'm not going to say don't focus on broker, but their focus is more on proprietary or branch. Okay, but customers have voted. That 75% of brokers, customers are going through broker. So what the bank should be doing, in my eyes, and this is my opinion, they should be building the relationship. We are the customer to the bank. Why aren't they building stronger relationship with broker? Why aren't they enhancing us? Why aren't they talking to us about cross-selling products, etc., to improve the profitability, to be able to work with us rather than just to take the loan or rather than focus on the branch network that's a more expensive processing model for them than dealing with broker.
I mean, for me as a consumer, my last couple of experiences of going into a branch is horrific, right? So that's probably, to touch on your point, you can almost be an extension arm of the bank, right? Like I need to speak to someone about my loan. I can just shoot you an email. We jump on a meeting, actually get an answer. My last 2 experiences of walking into a bank to try and sort something out, I either had to make an appointment or that person wasn't back in until 2 days later. It was a horrific experience. Maybe
you need to work in the bank system, but and make a few changes. But I really think they could treat their customers, being us and the 16,000 brokers out there, in a way better way, and they could enhance the relationship and still service the customer properly. Who wants to go into a branch these days? Who wants to go in there and have a look at 7 or 8 products when I've got 16,000 products out there?
Which, by the way, it's like 9 to 4 p.m.
Yeah, exactly. Yeah.
It's not easy to get in.
Yeah, and then the lack of skill within the bank system has decreased significantly. So unless the banks can pick that up enormously, it's going to be a very, very hard job for them to do that. But there's 4 new CEOs out there, the 4 major banks. So we're not really sure which direction they're taking it. But to answer your question, do they support broker as much as they should? No, they don't. Do they make it quicker for a broker? No, they don't. Do they make it quicker for proprietary and branch? Yes, they do. So why put the red tape in there for 74% of the market? It just doesn't make sense. But it's a challenge we've got, okay, that we've got in our industry. I don't think brokers are going away anywhere. Okay, maybe they're looking at digital and all different ways to take market share, but it's a problem we've had for a while. They don't have to love us, but they're in bed with us, and we should be working better together.
Yeah, and that's a good one that you touch on there in terms of the digital space, because I've seen some buyers agencies try to just be purely digital, like in terms of put the properties online, just select it almost like an eBay or off the shelf. And I think the reality is someone's got to go buy a product. It's not like they're buying a t-shirt or a new pair of shoes, right? There's a lot of thought and fear and concerns when it comes to buying. Is it the same side on the brokerage side? Like I can't imagine, you can submit all your documents online or whatever, but are you really feeling comfortable doing that without speaking to the professional on the other side when you're applying for whether it's a $500,000 or $1 million loan?
Yeah.
If you're serious about building wealth through property, you don't just need a loan, you need a strategy. And that's exactly what the Australian Lending and Investment Centre delivers. Australia's most awarded brokerage. They're not just looking at what you can borrow, they'll build you a holistic lending plan tailored to your long-term goals. We use them, we trust them, and so do our clients. So to find out more or to book your complimentary lending strategy session, head to the link in the show notes to connect with the team. Thanks for listening. Now back to the video.
Well, no doubt. I mean, AI is going to change things, okay? But are customers going to be comfortable? It's questionable. I mean, there's digital banks out there that have been trying this for 5 or 6 years, and they're the worst banks to deal with in the world, okay? So processing a loan takes twice as long, okay? So it hasn't worked to date, but no doubt that will change. And who knows what's in line for us with AI moving forward, but in that space.
I think so. I think you're right on that one in terms of, I think sometimes you got a client who's on the edge, they're nervous, they don't understand something. The last thing they want to do is talk to ChatGPT or the little prompt box on the website. They actually want to pick up the phone to somebody who's done this 1,000 times and just be like, no, this is normal. We've got to do, or we'll do A, B, and C instead. And I think you're absolutely right.
The investor space is a little bit more complicated and a lot of trust is involved. And a lot of people don't invest because they need the trust or don't have the trust. So I think we're a long way away before putting all their eggs in that basket to trust GTP or the AI stuff that's coming through.
Yeah. Now, I guess on that, I'm a big advocate of this, and I'd love to get your thoughts in terms of, I guess, what changes do you see maybe, and it might not be in the next 12 months, because I think that's too radical, but whether it's 3 years, 5 years, 10 years, like what kind of changes do you see in investing moving forward, like in terms of, are we going to see more guarantor loans? Are we going to see more joint ventures, whether it be, brother and sister, friends, group buying, in terms of, will people even be able to buy property by themselves, right? Like in terms of, we as a business, we used to purchase a really high percentage of investment properties for clients at that $500,000 price point or less.
Yeah.
That is now, we're on track this year to maybe do less than 25% of our transactions be under the $500,000 purchase price. So it's getting smaller and smaller. How long do they disappear? I guess, what changes do you see happening in the future for you guys?
We've got a challenge there, haven't you? You've got to go and find some markets under 400.
That's right.
Okay, so that's we'll leave that for you guys to sort out. What changes do I see? A lot of reinvesting. Okay, there's ways to create wealth. Okay, it's you don't have to live in it. You don't have to touch it. You don't have to feel it. So it's just strategically, what play have I got? Like I said before in the previous podcast we did, you can go and buy an investment property on 20K savings, and I say 55, 60K income. So if you're on that, there's ways into the market. So there's
that's with a guarantor? That's with a guarantor.
That's
okay,
guarantor.
So getting 20K, even if it's 20K from mum and dad, and then getting the guarantor, like it doesn't.
A bank might want to see you've saved something.
Yeah.
Okay, there's some banks that are more lenient on that than others.
Yeah.
But definitely, you can go and buy a 400K asset now and borrow for 10, okay, borrow more than 100%, put 20K in yourself. The parents go guarantor for 90K and offer their property as security. And we just have to prove serviceability, and we can do that. That's out there. So to answer your question, there's going to be more of that. The investor market, what other changes do I see in the investor market in the next 5 years? I see the next 2, 3, 4 years pretty strong with the lack of property, the lack of construction, the lack of the immigration issues, the population issues, the interstate migration issues. We've got a demand issue for probably, 30, 50 years ahead of us.
Yeah.
So, and we're at a time right now where rates are coming down. So a good time to be able to borrow and invest and take advantage of the market. So I see the next 5 years being really, really strong and a great opportunity for all those people that think they've missed the market because assets have gone up or grown to get in there now still and enable wealth and take advantage of all the problems that we have in Australia.
That's a really good thing you touched on there in terms of getting into the market, because if you're sitting in Melbourne and Sydney right now and maybe you can't afford to get in that market, you're thinking, I'm just going to save up for the next deposit.
Yeah.
how many clients in your experience have you seen save up quicker than the market?
None.
Yeah.
No. Okay. It's very rare. You got to be a massive income. You got to be a doctor on 300K or something like that, and to save quicker than that. And that's possibly not even choosing you'd have to choose a great market. Okay. A poor market for them to outperform that. What a lot of people are doing is a big percentage of the population will sit there and save and save and save and wait, where they should be hitting the market earlier to get the growth of the asset to outperform their savings. Okay, so by not doing that, you miss out on the opportunity. Okay, so if someone like Ripehouse can come along and deliver an asset that performs 35 to 50% growth over 3 to 5 years, okay, that's a lot of savings you've got to put in play.
Yeah, huge.
To beat that. So in 9 cases out of 10, or 9.5 cases out of 10, the sooner you get in, the better. And we're in prime times right now. You look at Melbourne market that's had 8 bad years. Most livable city, 5 or 6 times?
Yep, we just pants Sydney again.
Yep.
So we're in the Melbourne studio today, so I can say that. Yeah, we pants them again.
So it's looking prime. I know a lot of buyers advocates are actually jumping into Melbourne right now.
Yep.
And especially regional type outer areas in Melbourne. So great opportunity. Okay, rates are coming down. And so if you're under your cap of your borrowing capacity and you can do it, get to your broker, get to your banker.
Yeah.
Okay, and find out what your options are.
Yeah, and I guess you've got some pretty exciting changes on the ALIC business in terms of you've got an app or a software that's going to be available called Lolly.
Yep.
Do you mind touching in terms of what it actually does, and how it's going to provide value for customers moving forward?
Yeah, so ALIC, from the original podcast, we built ALIC because we want to educate customers, enable wealth. I've always wanted all customers to understand their net worth position, their borrowing capacity, their valuations, their retirement age, their cash flows pre and post tax. If they understand the exact costs to run particular assets and their exit strategies. So we built an app called Lolly, which we're very excited about, that actually tells all our customers that information at all times. So basically, as a customer, if they have their balance in there and the interest rate in there, they'll know what their borrowing capacity is. They'll know their daily valuations. They'll know their net worth position, and they'll have all this information and that's amended with any changes they make. If you change income, it will change your borrowing capacity. If the valuation is done today from 6 months ago, they can put that there, and those valuations are valuations that can be used by the bank. So the idea of Lolly is to make sure that all customers have a full financial position on a daily basis of exactly where they sit.
And I probably know the answer to this one, but without something like Lolly, how many clients have you actually spoke to that knew their net worth? They knew their cash flows. How many actually? Yeah. Many? Any?
If I walked out in the street right now and spoke to 100 people, probably one would know their net worth or close to it.
And he's probably a spreadsheet nerd like myself. And
probably. One would probably know. No one knows their borrowing capacity without calling up the bank. If you're empowered to know that on a daily basis, and how daunting is it that it's going to tell you your retirement age? Okay, so if you sit there and you say 42 and your net worth is 1.2 mil, okay, and the criteria is you need to be worth X million, okay, it will tell you what age you will be to reach that. So I reckon that's extremely powerful. Some people want to turn the notifications off because it's going to tell you things that you probably don't want to know.
Yep.
And it's ironic, a lot of people actually don't want to know this stuff, but they need to know it. Okay, so I think the majority of people avoid that information. It will sort itself out. We'll get there.
Yeah.
I got plenty of years. I'm only young. Yeah. But the reality is you need to be worth $4 to $7 million to hold a reasonable lifestyle in Melbourne, okay, by the time you turn 60. And the percentage of people that aren't there is incredible. So we built an app that we believe will do this. And then our customers, and this app talks back to us at ALIC in regards, it gives up updated information. So we know the client's position on a daily basis as well. So we think it's quite powerful, and we're pretty excited about it.
And what's the cost for a user to use that? Right.
Well, it's about to roll out. So the cost for an individual, depending on which level you get, okay, and I'll just touch on that as well. There's also Ripehouse property data on there.
Yep. That
shows you the top 50 properties in the country to buy. So those customers who don't want to use a buyer's advocate or want to do it themselves, there's some amazing data in there that shows you that you can buy it. This is the type of property. It won't give an address, clearly. Otherwise, people would just go and buy it.
Put us out of a job.
Put you out of a job. And the cost is going to be something like $6.99 a month or something really cheap.
Yep.
It's we're pretty pumped. We spent 3 years on it, and we think it will change the Australian public and how they operate financially.
Yeah. And having, seeing the demo with it, rolling it through with Damien, the running the business,
managing
essentially.
director,
Yeah, managing director at ALIC. I guess it's pretty powerful for someone who's a bit of a data and into the numbers with clients as well every day. I think just a great, really simple tool in terms of it's not overly complicated. You've just got to put your information in. But other than that, it's going to give you everything you need to know and more. And I think it's like nothing tells you you need to lose weight more than jumping on the scale.
And
saying that you're a few kilos overweight and seeing where your actual position is versus where you're actually heading towards. Nothing's going to actually make you change your habits than seeing that information.
Well, it's like it's your DIY broker kit, really. Okay, so most customers will call their broker. Can I buy that asset? Should I buy that? Not should I? Can I buy it? And what's my situation? Okay, it's going to be on your screen all day, every day, about exactly what your borrowing capacity is, exactly what your valuation is, exactly what your net worth is. So if you've got that, as an investor, I want that information daily. I want to know exactly where I sit financially. So you can make decisions around it from them. So yeah, we think it's powerful, and we're in the process of just finishing it off now. It's basically finished and rolling it out, hopefully through some of the big aggregators in the country.
Awesome. It sounds like a pretty invaluable tool in terms of like how having that information at the click of your button. It's going to be on your phone as well. I think you're saying you use through your phone.
Well, imagine the brokers out there that have that information for their customers. Okay, so we're hoping most brokers in the country want their customers on that, and they can deliver it to their client base. So that's the next step for us, the rollout stage over the next month or two. That's
super exciting, and I want to touch on something here. We maybe debated before we put the recording on whether we get into it, but I think it's a hot topic out there in the lending space, and we're going to talk about trusts. So for those people,
how did I know that was going to come up?
Yeah, of course. Well, I guess for those people listening in who maybe aren't aware of what the heck we're talking about here. So when you go and buy a property, there's more than one way you can buy it. I guess most people, when they go to buy a property, they buy it in their personal names or with their partner, joint tenants in common. Then there are other structures you can buy property. You can buy it in trusts, whether it be a unit trust, discretionary trust. They're the most common ones you probably know. You can also buy it in company structures. Trust is something that gets talked about in property forums, podcasts. It seems to be the
flavour of the month.
They're the Dubai chocolate of the buying space at the moment. I guess firstly, without obviously just really precursor here, this is not financial advice. Me and you are both not financial planners. What are your, just broad views on trusts, and what are your opinions on it at the moment?
So again, I'm not an accountant, okay, but from a lending perspective, so people buy in trusts to protect assets or to distribute income when they're cash flow positive.
And and I'll just jump in there. When you're talking about protecting assets, that's maybe you're running your business, maybe you work in a profession where
people, doctor,
and people can come after your assets, so you can protect yourself a little bit there.
Yeah, so it just gives you more protection, or distributing income when you're cash flow positive, and you're getting X amount of rent, and the costs are only this much, so you've got this much extra. You can distribute that income to beneficiaries. So you normally do it for those two reasons. What's my thoughts on trust in regard to it? There's a big consensus out there that you can borrow more money in a trust, and that is right and wrong. There's two sides to that. When it's negative geared, so negative geared, for the people that don't know, negative gear is when, say, your rent's, say, 20 grand and your costs are 30 grand to run, you're negative geared 10 grand. So that 10K comes off your gross income. So if you're on 100K and you make a loss of 10K after the rent comes through, the government will allow you to take that 10K off the 100, so you're only paying tax on 90.
So if you're a high income earner, you're going to get 45, 47 cents in the dollar back of that. 10K
so 45 cents of 10K, it might give you $4.5 grand or 4,600. $4.5 grand, exactly. So negative gearing is really the loss off the property comes off your gross income. So very simple. I tell my clients all the time, just remember loss off gross, and you understand negative gearing for the rest of your life. So when you're negative geared, a lot of banks don't take negative gearing into account when a trust is involved, so you can't borrow as much. So if I've got customers who come to me who have 4 or 5 properties over here in their personal name, and they buy the next one in the trust, that loan there you can't borrow as much because the negative gearing is not taken into account by the bank.
So you could borrow $1 million. The bank goes, well, I can't take that into account. Maybe you now can only borrow 700 or 800 or 900. Exactly
right. So I had a customer yesterday who's got 1.5 in approvals to buy 3. Spoke to me about trusts, and that will probably drop down to 1.2, 1.3 because the negative gearing on each of those 3 can't be counted. So that's the disadvantage. So the myth out there about trusts that you can borrow more is not always right. Okay. The time it is right is when that property goes to cash flow positive and your rent is higher than your costs, your interest, your rates, your maintenance, your management fees, your insurance, your water. When that's higher than your costs, when your costs are lower than your rent, that's cash flow positive. That asset, so that rent and that loan can be ignored for the next transaction. Okay?
Yeah.
But I'll say this, there's only a window that counts. So when it's, say, 90% geared, the rent is normally, in most cases, is less than your costs. Yeah? When it gets down to, say, under 60%, let's call it 50% lend. Okay, the rent is higher than the costs, but if the bank's ignoring the rent and the loan and the debt's quite low, you're actually disadvantaging yourself on borrowing capacity. So there's only a small window there that you can borrow more money in a trust, but only when it's cash flow positive.
Yeah.
And some banks will want an accountant's letter or want a stat deck signed off to say. The bottom line is it only increases borrowing by about 15% when it's in the window. So outside of the window, at the top, when it's negatively geared, you're losing about 10%.
Yep.
In the window, you get an extra 15% borrowing power. And below the window, you're actually losing out again.
Yeah. And I know the answer to this one, but I'll throw it to you. In terms of, I imagine the interest rates aren't the same.
True. So interest rates can be slightly higher. The other thing is a lot of banks don't deal with. So if you're going through, some banks don't even deal with trusts. Okay. So if you go to Westpac or Bank of Melbourne, their trust won't even go through their standard channels. They've got to through a business bank.
Yep.
Okay. So they find it complicated. They want to put it to an area that can manage it. If you go to second tiers, some of them don't deal with trusts at all. So you can't even do the strategies with them, and you can't go to third tiers. So the way you borrow a lot of money, so say that's your cap. The only way you can borrow above the cap at a major bank or at most institutions is to go to second tiers and third tiers. Yeah. If they don't deal with trusts, then you can't do the trust structure anyhow.
Yeah.
So
which is going to make you more negatively geared, right? You're taking on an extra quarter, half, maybe a full % as you go down the line. Like the negative.
Yeah. So the rate's higher.
Yeah.
So the rate's higher. So the running cost is higher. Yeah. So how long is it before it becomes cash flow positive? Yeah. So it is a myth, the whole thing. Okay, but a lot of people ask about it regularly. I'm sure they ask you. They ask us.
All the time. Yep.
Yeah, and I've got to explain the same story. I need to put it on tape.
Yeah.
So I can just send it out. Okay, so I don't necessarily believe in it. I believe there's a place for it. I believe there's times for it. I believe you should protect assets. I don't believe that you're just doing it to increase your borrowing capacity. I don't think you should do it just to increase your borrowing capacity. And one big believer I've got, and I mentioned in the first podcast, is if you only can borrow that much, okay, and through first, second, third tiers, you can borrow that much, yeah? Should you really be borrowing more? Because if rates go up, well, you lose your job. A lot of the people who have, say, their borrowing capacity is 1.5, but they borrowed 2.5 and found a way to do that, okay, we see a lot of people get in serious trouble.
Yeah, and that probably goes to the question or the answer that I give to clients when I'm asked the question. And again, it's always not financial advice.
Yep.
But you can go out there. You can purchase a property in a trust. And like I said, some people it's going to be the actual right way for them because you don't know their personal circumstances. Are they running their own business, their profession, etc. And that's why they should go get a team around them. But you go out there and purchase a property, 80, 90% lend, interest rates probably closer to 7 than 6 when you're in a trust.
Yep.
You're going to be 20 grand negatively geared more often than not. Mm-hmm. And if you've got 4 or 5 of those properties, it's fantastic that you'd be able to get the access to lending, which maybe getting a dodgy accountant's letter or whatever. But do you actually have the cash flow to manage that?
Yeah.
And which most people don't, unfortunately.
Yeah.
And then also on top of that, and maybe you can speak to this, like banks can change policy, right? Like it's not forever thing and you might want to go refinance later on. And if they've changed the policy, like are their hands going to be tied?
True. So I keep talking about this line. That's your capacity. So they change the policies, okay, and you're above the line, you can't do anything. Okay.
And all of a sudden interest only wears off. Then
you go to P&I payments and P&I payments, you increase your payments normally by 30%. Okay, so all those customers who come off interest only in the last, the 1.99s we spoke about, we saw some crazy rates. I was down to 1.59, I think I saw at one stage, say 4 years ago. So all those have come off. They haven't just gone up in rate when it's come off. They've gone from P&I, so interest only to P&I. So that's another 30%.
Yeah. So their rate's nearly tripled, and then they get another 30% on top of that. So it's
so in a great world, it all sounds good. But we should be lending and people should be borrowing in ways to reduce risk, not maximize risk. And the people that normally are looking at it are people that aren't on higher incomes anyhow.
Yeah.
And they've got a bit excited. I just bought 2 houses. I've made X money because Ripehouse have done a great job, or their buyers advocates done really well. They want to buy 2 more and they think it's very rosy and we can keep doing it. And it's a retirement thing. In actual fact, we should be protecting ourselves for market changes, policy changes, bank changes, RBA rate changes, and making sure we're okay.
I think there's a bit of a theme sometimes too with the people that want to go down that route. They're young guys or girls, maybe they're single or they got no kids, and your risk profile a lot different.
More aggressive.
Yeah, right. But then all of a sudden, like, you need to think, like, where am I going to be in 2 or 3 years? Am I about to get married?
Yeah.
Do we have a couple of kids?
What life changes are coming through?
Yeah, that's right. Because once that happens, like,
and then they're relying on the market to increase.
Yeah,
and the uplift in the market. And that's if they've done the research and got the right data, like Ripehouse provide, then off we go. And then they may be okay. But I can tell you 16 rate increase or 18.25 is equivalent to put a lot of people in a lot of problems.
Yeah.
And there's a lot of people burnt from that. And just touching on people that get burnt from an investment, most cases what they do, they get burnt. They don't go near it and they leave it for 5 or 10 years and they get back in the market again after 5 or 10 years at a completely wrong time and they get burnt again. Okay, so you see that happen regularly.
Yeah.
They should be getting back into the market sooner than later and getting the right people around them to make the right choices.
Oh, more often than not, when I'm speaking with clients who've been burnt before, as you'd know, they bought the wrong type of property. They've either bought in the wrong market because they jumped in at basically the end of the cycle, or they've bought the brand new house and land package or apartment complex, or they've bought something chasing cash flow. They've bought one that sticks out is somebody bought a share accommodation house and it was filled with uni students. How do you reckon that turned out for him? He reckons it was a full-time job in itself.
Mining towns.
Yeah. So it's just like their experiences, and that'll just put you off forever, right? It just becomes
it's natural to be burnt from that and go, I'm going to learn from that. I'll not do it. I won't do it anymore. But the people that then come back in do it at the wrong time again.
Yeah.
Okay, so it's just get a great team around you to talk through that and understand it. But the whole issue at the moment with those people coming off, their rates have gone up from 1.99, say, to, say, 6.5. If they go interest only, I think it got as high as 6.8.
Yeah.
So it nearly went up, 5%? And then add P&I payments of 30% on top if they didn't have serviceability. So they were immediate sales they had to do to control and afford those payments. They had to exit.
Yeah.
And exiting at any time when you're being forced to is obviously not a good thing.
Yeah. And I think the data on a lot of those, we get asked about mortgagee sales, which I'm sure you do as well.
Yeah.
They're always in the same pockets, right? They're not happening in your Brightons or your Turaks or, your Northern Beach suburbs in Sydney. They're out in the suburbs where, affordability's there's a crunch in terms of income, right? Or single income earners. So
I suppose those people, those customers or people out there are trying to get a quick buck. The one thing I've learned from investment, and I've been doing it since I was 21, you don't need to build Rome tomorrow. Put your toe in the water. Act within the guidelines, okay? If the bank's saying don't do it, there's probably a fair chance you shouldn't do it, okay? I'm not saying don't be creative. Let's be creative. Okay, let's do ownerships. Let's do re-gearing. Let's capitalize interest. Let's do all this funky stuff that we can do. Okay, but let's still act within the guidelines and the requirements and the regulations. And normally they're there to protect you. Okay, then if you have good advisors around you about where to buy, what to buy, and exit strategies, and good structuring around you, it's very hard to really make big errors.
Yeah, and I guess probably the last question to cover off for today, Mark. We appreciate your time today, and we definitely have to get you in every quarter or so when we've got some big news to drop on the lending or the RBA rates. But what do customers need to know right now
from an investment perspective?
Yeah, or from a lending perspective, what do they really?
What do my customers need to know? They need to know their borrowing power. They need to know what's happening in the market out there. They need to be up on what's happening around demand and supply issues that we have, which that bit doesn't come from us, it more comes from you. They need to know their cash flows. They need to know what they live on. What's their budget? What do I save? What percentage of my income do I put to investments and what percentage do I save? Okay. And most people believe wealth creation comes from investing and not saving. It is a combination of both. Because if the market stops or we have world issues, if you aren't saving anything and you're living on what you're earning, you actually aren't going ahead. So it's really, really critical that wealth creation comes from both of those things. So the advice I can give is you need to know those 4, 5, 6 things, okay, and be up on it and be catching up with your advisors every year as a minimum. Sometimes my customers will catch up every 4 or 5 months, and we'll just run meetings strategically about what we could do, and then fill in the gaps and getting them to the people on the things that we can't advise on. But our best customers will be twice a year, maybe 3 times, and at least every 12, 18 months they should be catching up with you on the property side about what's going on with your markets, exit strategies, when do we sell, and us around what changes have occurred in the lending market, borrowing power, valuations, various strategies to clear home loan debt.
Awesome. Well, Mark, it's been a pleasure getting you in again today. Looking forward to catching up soon, and we'll make sure we leave some details of at the end of this recording how they, if somebody's listening and they want to speak to somebody on a strategic lending side, they'll be able to reach out to you and your team.
We'd love to talk to them. Thanks for having me.
Thanks again. Thanks for watching. If you want to see some high-performing suburbs, then grab our free suburb performance report below. It's packed with data we use every day to guide our clients.